Thank you, Aidan. I'll kick off. And good afternoon, everyone. My name is Danny Shuttleworth, and I'm going to start by providing some context for today's presentation by giving an overview of the Australian life insurance market, which continues to be a highly competitive market. Chen, if we can move through to the pie chart slide. Thank you. Thank you very much. The left-hand pie chart shows that independent financial advisors, or IFAs, are the primary distribution channel for individual or retail life insurance business in Australia. A limited number of players compete strongly in this space, as shown in the centre pie chart. These companies all need to convince IFAs to support them to effectively distribute their products. Traditionally, competition has primarily manifested itself in the form of sharper prices and more complex offerings with increasingly liberal benefits, all in an attempt to secure the highest product ratings from the research houses and so be regarded more favourably by financial advisors. Disability income insurance, sometimes also called income protection insurance, is very important in Australia, as shown on the right-hand pie chart. Generally, it is the lead product that advisors promote to customers, and penetration levels in Australia are relatively high compared to most other countries. Disability income insurance is commonly packaged with lump sum products, so the underwriter of the disability income insurance typically gets to underwrite all of the customer's business. If we could move on to the next slide. From 2014 to 2019, this competitive environment and the functioning of the life insurance ecosystem led to a significant deterioration in customer and industry outcomes in Australia. Underlying claims experience deteriorated sharply and almost doubled over the decade to 2019. As a result, there were very significant and commensurate price increases for customers. Industry losses of well over $3 billion were recorded over this period, and the total losses were actually almost certainly higher when overseas reinsurance and retrocessions are taken into account. This environment also resulted in material adverse outcomes for customers, particularly the large price increases and associated affordability concerns. Throughout this period, there was also perceived to be a material first mover disadvantage. Moving to a more sustainable product would likely result in lost sales, and standing in the market would be reduced. If we could, there were real concerns. Sorry, we could just go back one slide, Chen. There were real concerns about the sustainability and ongoing viability of this market and the prospect of a lack of availability of product for customers moving forward. These circumstances all laid the groundwork for the Actuaries Institute to establish the Disability Insurance Taskforce to consider what we could do as a profession to assist in better community and consumer outcomes. Next slide, please, Chen. Importantly, one of the first actions of the task force was to define sustainability in an Australian disability insurance market context. That is, what was it that we were trying to solve for? This slide sets out where we landed in terms of that definition of sustainability. Products that perform as expected by customers and focus on insurable interests, prices that are more stable and predictable, product features and underwriting that promote alignment between customer and insurer, financial outcomes that appropriately support insurance viability and product availability, and community confidence in the value and fairness of disability insurance. Next slide. The Institute's terms of reference for the task force states that the purpose of the task force is to objectively and analytically assess the many factors at play in the disability insurance market, to assist in delivering good customer outcomes and effective product availability and sustainability. Quite deliberately, community and customer outcomes were placed at the centre of that ecosystem that we were considering, reflecting the focus of the work of the task force and the belief that having this focus would benefit the entire ecosystem and related market participants. The task force set about looking at the causes of the adverse customer and industry outcomes just described. We examined the entire ecosystem. We looked in detail at the issues arising and what exactly was driving these adverse outcomes. There was extensive stakeholder feedback, and detailed consultation documents were released for feedback as well. Ultimately, this resulted in the release of an extensive findings and recommendations document in 2021, which was updated in December 2022. In total, over 40 recommendations have been made across a wide range of issues and stakeholders, covering customer and community interests, company governance, regulatory change, and suggested technical and professional improvements. Our focus today is on product risk management. However, interested attendees should refer to the Actuaries Institute website to access the full suite of documents published and the associated recommendations. I'll now hand over to Chen to discuss specific product offerings and features in more detail and the actions taken to help address some of these underlying issues.
Thank you, Danny. As Danny mentioned earlier, the task force was originally established to review the issues underlying the performance of the individual disability income product. One of the key aspects the task force explored is the product design. In January 2020, KPMG Australia published a report which looked at the difference in the product offerings across a few different markets. The product workstream of the task force has leveraged the findings in this report and produced a graph on this slide. There's a lot of useful information on this slide. For the purpose of this presentation, however, I'm not going to go through all of them in detail. But if you look at the overall insurability, which takes into consideration all the individual product features, it's pretty clear that Australia's product offering is the most liberal across all the markets. In addition, the product here in Australia is also offered to a broader target market, which means we've also got the highest market penetration. On the next slide, I'll briefly touch on some of the adverse outcomes as a result of this. First of all, it's very difficult to predict the claim cost at the pricing stage. The individual product features and the interaction between the features can have a large influence on the claimant's willingness to return to work. For instance, the motivation of someone returning to work will be much lower if the person has a large amount of cover and a long benefit period. Over time, insurers start to make more and more losses on claims. As insurers report losses, they then start looking for levers to restore profitability. Unfortunately, the only effective lever is to put up the price. So what are the customers' reaction then? They get upset, they lose trust on their insurers, and if they're still healthy, they may choose to either insure with someone else or completely discontinue their cover. This is what we call selective lapsation. And then the market steps into a vicious cycle of reporting more losses, more premium increases, and further selective lapses. Eventually, this contributes to the losses we've seen earlier. With the industry suffering huge losses from this book, we've since embarked on a journey of sustainability. Actions were taken by other prudential regulator APRA, the actuarial profession, including the task force, and the individual market players. Those actions cover areas including the strategy, governance, product, pricing, and data. Again, I'm not going to go into too much detail into each of the specific measures, but I just wanted to draw your attention to the product-related features in the next slide. By March 2020, life companies have stopped selling agree value policies to meet our price expectations. You may want to ask, what is an agree value policy? For your context, the cover amount for agree value policy is determined based on income at the policy inception, which means there's no financial underwriting at the time of claim. This particular feature violates the principle of indemnity and therefore is misaligned to insurability principles. By October 2021, again, to meet APRA's expectations, the income replacement ratios were capped at certain levels, and life companies are now expected to demonstrate control to APRA if they were to continue to sell products with a long benefit period. By March 22, all market participants have launched a new version of the product that meets APRA's expectations. In addition, companies have also introduced some other product changes to further strengthen the control and the risk management of the product. As a result of the product changes, we've observed a few shifts in the market. One, there's a tightening in occupation definition around incapacity to work. Two, we've now made it compulsory for the claimants to receive necessary treatment and participate in the rehabilitation program. And lastly, the overall replacement ratio has reduced. So now let's take a look at the international comparison graph again and see where we're at. As you can see, Australia used to be almost an outlier when it comes down to the individual product features. The tightening of the product features have now brought Australia back in line with the rest of the markets in the comparison. Now you might ask, so what are the impact of all those on the profitability? Danny has previously shown you the reported profit and loss for this book up until 2019. This graph has now been extended to capture the more recent developments. It appears that the market has turned around following the losses suffered in the previous years. Does it really mean that the market is now back on track? In a recent message to the industry, APRA commented that the reported profit in the recent period may well be driven by the movement in the bond yield, the repricing activities, and the release of COVID-19 reserves. On this basis, although it is a positive sign that we're now seeing profits on this book, the Australian life insurance industry still has a long way to go on its sustainability journey. Now, I'm going to hand over to Alan to discuss some learnings we do based on our past mistakes and the roles we can play as actuaries in the risk management phase of life insurance products.
Thanks, Chen. So that leaves us obviously with what can we take from this experience that we've had in Australia in individual disability income, more generally for actuaries working in various markets in life and health insurance. Chen, if you can go to the next slide. Danny painted a picture early on of the ecosystem, and while that's Australia, in other markets, the ecosystem's not so different. And actuaries, as actuaries, we all work as part of this ecosystem and what we hope is a critical component in ensuring that products are sustainable. Moving from the left-hand side to the right-hand side, life insurers exist to provide long-term protection to our customers. And to do this, we need to find a balance of providing features that meet customer needs with pricing that allows for the expected cost, as well as the uncertainty around those costs, all built together into the pricing and the terms of the products that we offer. Given the nature of the services we provide, consumers and intermediaries can find it very difficult to understand the value of the products. Having a robust understanding of sustainability in the products allows management to make choices around the appropriate pricing and the appropriate product terms. We need to have an understanding of the ongoing sustainability of the products for in-force customers so that we can provide better information to consumers and intermediaries to help them assess product stability and value of the benefits and make their own choices. Ultimately, governance and oversight of serving customers effectively and sustainably lies with the board to ensure management takes the responsibility seriously and demonstrates how it manages products to do so. It's not good enough to just rely on the ability to change products in future or pricing in future in response to future adverse experience. Insurers, with the help of their actuaries, need to assess the uncertainty involved in providing long-term protection products to customers and to ensure that they are providing value to the consumer with an acceptable and understood level of affordability and future stability. We can only do this effectively through the whole value chain, from product design to sales, underwriting, claims, renewals, and ongoing customer support processes. Actuaries do need the underlying insurance need, not just the consumer outcomes. Actuaries also need to work more closely with claims management and underwriting, not just to ensure visibility of changes in those practices. In particular, claims managers often feel the impact of definitions in products before anyone else in the business sees them and sees the data. The risk management role is to provide a holistic view across the insurer's activities, with CROs supporting that the processes used by the insurer are adequate and effective. Regardless of what we do individually in each organisation, insurers do not operate in a vacuum. In a competitive environment, as Danny and Chen have referred to, the desire to make products more attractive can create a race to the bottom with either poor value for customers, for example, through complexity in product for little added value, or high uncertainty for insurer sustainability with benefits that are difficult to price or can have misaligned incentives for policyholder, leading to uninsurability. In that competitive environment, being the first mover to repair issues can have a disadvantage. This is a very challenging situation for a market, but waiting for the regulator to step in can have unforeseen negative consequences. Where there is an industry issue, fronting it early and where possible collectively is better. As Chen said, we saw intervention by the regulator to create very high incentives for the insurer to change the products. It's clear that a holistic approach is needed to manage product risk and sustainability of long-term products and the promises we make with a level of stability of products that customers can understand and accept. Actuaries and the work we do are key to this. So as actuaries, how best can we make this work? Chen, if you can move to the next slide, please. To be effective, it's not just what we do, but also how we do it. Our responsibility is to ensure that insurers can provide that effective long-term and valuable protection service to the community. This responsibility goes much further than applying strong technical skills. The technical skills are table stakes or the minimum we need to do. We need to use our technical skills and knowledge to provide useful and relevant advice and to influence for action. Doing the technical work in the right way is just that minimum assessment. When we're speaking to complex topics, uncertainty about outcomes in the future, we need to find ways to communicate this effectively to a variety of stakeholders. The type of communication mechanisms we use will vary with knowledge and understanding, as well as the time available of the people we're trying to get our message across to. Ultimately, boards need to oversee the insurer's activities and need to understand those risks and impacts on companies' sustainability and customer outcomes. 200-page complex technical papers will not work with boards. Scenarios, illustrations, scorecards, discussions can be much, much more effective. A non-actuary CEO peer of mine once told me how he saw effective actuarial advisors working. Certainly, he didn't expect actuaries to always say yes to anything that was proposed. But also, he didn't just expect them to say no to anything proposed. So it was a mixture of bringing positive and constructive thinking. And the example he used is, yes, we could do that, and it would be even better if we did this. Or no, we can't do that, but here's another way we could do it that would make it work. With that type of approach, we earn respect and trust and are asked for help, and we don't have to force ourselves into decision-making. Sometimes, though, we do just need to step up and speak up. Whether what is being proposed is wrong for the customer or wrong for the company, there are times we just need to be clear about our views and be clear and direct about the potential outcomes of following a potential path that the industry or management is heading down. We as actuaries have a role as custodians of the provision of effective, affordable and well understood long-term insurance to the community, and we're the foundations, the bridge to continuing to do this tomorrow and into the future. Thanks for hearing us out, and I'll pass back to Aidan to manage some questions that we hope to get from you all.
Thanks, Alan, Chen and Danny. And just another point to the audience, if you could ask your questions early as possible, because they do take a while to come through. But again, thank you, speakers. These are all very experienced actuaries and members of the Actuaries Institute Disability Taskforce. So the first question I have coming through from Greg Barn is, to what extent has the improvement of profit from disability income business impacted the increases in interest rates? Have been impacted by? So Chen, I think you noted an aspect of this.
It's a question more on the improvement in profitability I've seen. So a couple of days ago, I think there's a session hosted by Chen in relation to the disability experience more recently. So they had a commentary saying, you know, with the new product that was released more recently, we don't know about the experience yet. And I do agree with that sort of commentary. Unfortunately, with the long-term nature of the life insurance product, we're not going to be able to see the full emergence of the experience until many years into the future. So from our perspective, though, we do feel like that the industry is overall moving into the right direction from the product sustainability point of view. And in addition to that, even though it's like most of the drivers more recently were not particularly related to the tightening of the product, but I guess one of the observations that we can make is historically life insurers were having to strengthening their assumptions, and all those impacts were having to be capitalized into their balance sheet. At present, the fact that over the more recent years we've got the experience under control now, it's a positive sign that now hopefully we understand our risk a little bit better and we can price our product a little bit better. Danny and Alan, do you guys have anything that you want to add?
No, I thought you answered it well, Chen.
Cool. Thanks very much. I've got another question here, this one for Danny. So you noted that the sustainability issues arose in the Australian DI market relate to the entire ecosystem. For different markets, maybe where we don't have a lot of volume from financial advisors, or say the product offering between companies is less transparent, do you envisage that similar product risk could arise with similar adverse customer and industry outcomes?
Yeah, okay, thanks, Aidan. I think the short answer is yes. As a task force, we would think that's a possibility, and we've actually extended our work into other disability related areas. We were deliberately called the Disability Insurance Taskforce rather than Disability Income Taskforce. So whilst the specific distribution and product characteristics of the disability income market certainly contributed to the deterioration in sustainability, as we showed, there's a significant ecosystem that sits sort of around that as well that need to be considered, and there are some underlying themes that and learnings that we believe are relevant for other products. So if you go back to the definition of sustainability that we started with, and the 5 or 6 key areas that talked about prices being more stable and predictable, and products that perform as expected by customers, and look at the rest of that definition. If you've got any product design in any market that doesn't meet those definitions or objectives or outcomes that you're looking for, then there is a risk that similar sustainability issues could arise. And we've seen that in Australia, in other markets with different distributions. So I'm sure that would be applicable overseas as well.
Danny, I might add something. In fact, I think the risk is almost greater, and that's why it's really important that actuaries think about this. In an emerging or a new market, we typically don't have the data to understand the types of risks that might be taken on, and that creates a challenge for us. The answer shouldn't be run away from offering the product, but it should be about considering what the outcomes could be, and then trying to either design product or set pricing and set management philosophy and triggers and actions to monitor it. So I think it's even more important in some other markets where there might be less experience. One of the learnings in Australia was that some of the data that we could have had that might have given us more certainty and more information we didn't have. So that's the other aspect of this for some people overseas. If you're heading down the path of introducing new products or opening up new markets and new insurance offerings, thinking about the data that you might want to start collecting early so that you can build up that knowledge and create greater certainty around the information that we're providing our stakeholders.
Thanks, Alan and Danny. Alan, I really liked how you took on the learnings from the actuary's perspective. What can we learn from this? But I also saw a piece on your slide about regulatory intervention versus industry self-correction. So this is an open question to either of the panelists, but what do you think the regulators might have learned from this event? Because our regulator issued a number of statements and letters before finally intervening. So do you think they might have done something different in hindsight?
Danny, do you want to pick that up first? Or
yeah, it's not our place to really comment on the regulators' approach or actions, other than maybe some observations. I guess what I observe now is the regulators increasingly asking the industry to take more direct control and ownership. The regulator shouldn't have to step in to affect good change and change that's good for customers and for the community. And the industry should be really the first port of call and take responsibility for that. And that's something that I'm very attuned and aligned with, and I think that's a learning for the industry and all of the ecosystem, including ourselves as actuaries, to take into account moving forward.
Yeah, I'd just echo that, and it's much the comments I made. I think it's incumbent on the try and take action first rather than wait for a regulator. So rather than speaking to lessons for the regulator, I think the lesson for the industry is, and for others overseas, is to don't wait for the regulator to act, because often that will have different, possibly negative consequences, different ways of managing things, and it's far better for us to step up in advance and try and solve the problems ourselves.
Absolutely, well said, Alan and Danny. On that topic, has it just been competitive behaviour as the main driver of these sustainability issues we've seen in disability income insurance market in Australia?
I'll kick off. I think it's certainly been one of the key contributors to the sustainability challenges that we've seen, but it's important to note the work of the task force in looking at that entire ecosystem that we put up in our presentation, that shows it is a complex ecosystem with many participants and stakeholders and related issues. So you can't just put it down to competitive behaviour by any means. You've got to look across customer interests, corporate governance, other technical and professional improvements that need to be considered moving forward. And I guess to look at those, this presentation has been focused on product risk, but I'd encourage people again to go to the Actuaries Institute website and look at the full findings and recommendations document, and look across the recommendations to see all of the issues we believe were involved, including competitive behaviour.
I think the only thing I would add is that in the interpretation of what is competitive behaviour is interesting, and there can be a big difference between perceived value and actual value in the products, and consumers, because of the complexity of our products, often find them very hard to assess. Similarly, intermediaries, where we're operating through them, either agents or IFAs, as in Australia. Again, I think it comes back to the industry and the people who really understand the products throughout the insurers to firstly think about what does the customer need and how do we put those products together that really address needs, really solve insurance problems, and then communicate in a way both externally and internally around what the value of those products are. And that's not really a competitive issue. Really, we should be, if we're doing that well, the people will understand what they're buying and hopefully seek the products more.